Good evening, everybody. Good afternoon, wherever you are in the world. And welcome back to Walks on Wall Street. Well, today was the day we heard from the Federal Reserve Fed Chairman Jerome Powell. At the conclusion of the FOMC meeting, we did get a 75 basis point rate hike after the widely anticipated 50 basis point rate hike. But as we know, last week, the CPI numbers came in higher than expected, prompting the Federal Reserve to go a little bit bigger to raise interest rates 75 basis points. So it seems as if the futures markets predicted this rate hike pretty accurately. There was about a 97 or 93 to 97% probability, according to the futures market, that the Federal Reserve would raise interest rates today by 75 basis points. So tonight, I think we are going to spend the majority of our time talking about the difference between fiscal and monetary policy. We are also going to be talking about what could be the possible causes of this inflation. Obviously, almost every night on the stream, we talk about how the monetary policy has been causing much of this inflation, but I think the fiscal side of the house, and if we can do a quick review, monetary policy refers to the central banking, and fiscal policy refers to government spending and how government chooses to spend tax dollars. And I think the government shares a big part of the blame as well. It's not just the Fed. And I think that not only me, but many other analysts on the street can really come off as the impression that the Fed is the only thing to blame here for this inflation. But I think there's also multiple other factors. And I think that from the meeting today with Fed Chairman Jerome Powell, he did make some good points. We'll talk a little bit about the supply chain disruptions. You know, about halfway through Fed Chairman Jerome Powell's speech, he was talking about the big issue or the big impact of China's zero COVID policy, which we've been also talking about almost to the point of ad nauseum on the streams. And that's causing complete and total supply chain havoc. And I'm actually seeing that firsthand in my job in enterprise tech sales when I try to get custom builds of specific routers and things like that. The supply chains are really, really messed up, causing much of the inflation. Now, if we drill down deep into the CPI numbers that we got last week, well, much of the hold on one second, let me put my backpack away. There's a rat right under me. Don't really want to deal with the rat right now. Much of the CPI, so you have the regular CPI, which came in at, I believe, about 8.6%. But if we look at the core CPI, and the core CPI is excluding volatile energy prices and food, that actually did moderate. So it seems that right now, if supply chains were solved and supply chains normalized, which I think is going to be a little bit of a long ways away, and energy prices can come down, I think we have a pretty good shot at lowering inflation back to the Federal Reserve's original target, which is roughly 2%. Now, even though we did get a 75 basis point rate hike today, the Fed funds rate is still at a projected level of about 1.5 to 1.75%, which is still historically low. And given that fact, if we look at the going interest rate on a 30-year fixed rate mortgage, we are now over 6%. So as we fast forward throughout the rest of the year, many economists are projecting that the Fed's funds rate will settle right at about 3.4%. And if that's the case, where do we think the yield on the 30-year fixed rate mortgage will be? Do we think it can break double digits? I don't know, but we'll talk about that tonight on the stream and more. But everybody, we are downtown on Wall Street. I will check the chat to see who we have here. But I was working for a little bit today, right here at 110 Wall Street, which they have a WeWork location. It is a very windy night out. Very cool. I'm actually a little bit cold. So we'll be walking across the Brooklyn Bridge tonight. There's not a cloud in the sky, so we should have a beautiful view. We'll talk about the Federal Reserve's FOMC meeting, and we'll also talk about the housing market, because there's been a lot of debate, especially today, if we are going to see a housing crash. And I think there's a couple things that we need to look at. But first, let's see who we have in the chat, my friends. We have Cosmo Scary. Good to see you, Cosmo. We have RJ. This is Olaf from Colorado. Tom, welcome. RJ, Samantha R. Jonathan Richards. Good to see everybody. Sunshine After Rain. Santa Monica Rodriguez. Exploration is here. Tamara says hello, everybody, and good evening from Texas. Good to see you. Savi is here. Dante Rose. Fascinating. Welcome. Roy S. Sunshine After Rain. Ruby Falcone is here. Good to see you, Ruby. Welcome, welcome. Murky says, looks like a beautiful night in New York City. Good to see you, Murky. Welcome. Iris says, good evening, everybody. And Tom, good to see you. FredX, Andre Brown, Eyeglass Lady, good to see you. Chris Beeman, welcome from Arizona. Vinny Castellano says, look out, Brooklyn, here we come. Vinny Castellano, hopefully you're doing well. Hopefully Maria Castellano is doing well in addition to you. But it's a beautiful night. It was a beautiful day in Manhattan. Really, really nice day, but it's actually a little bit cold. It's actually a little bit chilly. I'm not sure if you guys can see by the leaves blowing around here. It's actually pretty windy. It's actually pretty windy, but we are starting off the stream right on the corner of Water Street and Wall Street. Now, things have changed since I've been down here. I actually used to work in the building directly in front of us. I used to be my old office, but it is now actually converted into a hotel. It's called the Wall Street Hotel, which is kind of interesting to see. Otto is here, says, hey, good to see you, Otto, welcome. Ed T is here, says, yo, Tom, good to see you, Ed. Good to see you, my friend. I see Mr. Ming, good to see you. This is raining where I am. You know, I felt a couple raindrops tonight. Hopefully it doesn't rain while we're streaming. But everybody, real quick, this building that we're looking at right now is called 95 Wall Street. And if you remember correctly from last night's stream, we were talking about how a lot of the old apartments, a lot of the old office buildings are now being converted into luxury apartment buildings. This is one of them, 95 Wall. Even though it sort of looks like an office building, it's actually luxury apartments. And rather expensive apartments as well. So let's start our walk down Water Street and let's check out the scene over the Brooklyn Bridge. I'm excited for tonight's stream. Hey, Flat Smack says, hey, you guys, and sub Tom, sub Flat Smack, good to see you. Hopefully you had a productive day. Happy middle of the week, by the way, everybody. We're halfway through the week. It should turn out to be a beautiful weekend, so hopefully we will have the skateboard out. Sally is here, says beautiful view. Andres is planning on getting a house in the near future. Is there anything you can tell me before I go looking? I guess it just depends where you're looking, Andre. Let us know where you're looking. But I'm so glad you asked that question, because there was something extremely, extremely eye-catching to me that came out of Fed Chair's mouth today. And obviously I'm going to paraphrase because I don't remember the exact words he said. But I believe it was a journalist from the New York Times. Obviously this was during the Q&A portion of the conference, or the speech, or whatever you want to call it. And she asked about the housing market. And Fed Chairman Jerome Powell said, if you were a young person in America right now, looking to get a house, you're going to want a reset. Did anybody hear that? Maybe I was the only one watching the Fed's speech, but he said that. He said if anybody in America, a young person specifically, is looking to purchase their first house, you are going to want a reset. And I think what he meant by that, and we could talk about it in the chat, I think what Fed Chair Jerome Powell meant by that is he understands that it is just totally unaffordable for anybody to try to get a house right now. And with interest rates going up, I mean, a 30-year fixed rate mortgage is over 6% now, probably on its way to 7%. And if real estate prices do not come down, it's almost your monthly payment on a $500,000 house has nearly doubled just in the last 2 months. So we're going to talk about if we see in the cards an imminent housing crash. I'm not so sure we'll see a major crash like we saw in 2008, because at the end of the day, in order for us to get that massive housing sell-off, that massive crash, there needs to be a huge glut of supply coming onto the market. And right now, inventories are still relatively low. But if we start to see a wave of defaults, we'll start to see a lot of houses come on the market. But as we've been saying, we've been talking about, and obviously it's up for debate, and I think we always have good conversations here on the stream, I think a lot of the underwriting standards have improved drastically from 2008. So let's just review that really quick. In 2008, you could qualify for a mortgage with no income verification, with a very low credit score, very little down payments, and we haven't really seen that sort of irrational exuberance and poor underwriting quality and standards in this housing boom. We really haven't seen that. Also, we haven't seen, oh wow, this bank is completely empty now. I used to go in this bank almost every day. This was the JP Morgan Chase Bank here on Water Street, Fletcher. Also, in 2008, 2007, 2008, leading up to the financial crisis, many people were getting their mortgages with adjustable rates or adjustable rate mortgages, in which case, as the Federal Reserve raised interest rates and as interest rates went up, so did the payment on those loans. Now, what I think will happen, I think we'll probably get anywhere from like a 15 to 20% correction in housing across the board. Maybe a little bit less, but I think we'll probably get that 15 to 20% correction in the hottest markets. So you talk about like the Arizonas of the world and things like that in isolated parts. But you're not really going to see 50% declines, 60% declines unless we start to see a wave of defaults and foreclosures, which I just don't see that in the cards right now. But we'll talk about it. We'll talk about it. But it was just really, really interesting that Fed Chair Jerome Powell said that. And obviously I'm paraphrasing. He said, if you're a young person in America today trying to get into a house, you're going to want to reset. So is he sort of forecasting that the housing market is going to crash? And is he sort of preparing us for that? I don't know. What do you guys think? What do you guys think? Iris Blue says building materials are high, housing costs more. More people need house, not enough affordable housing. I agree with you there. Let me check some of the comments. Hey, Sebastian is here. Says, hey, Tom, good to see you, Sebastian. April Benson says a lot of defaults from COVID, not paying on loan. Hey, Ryan Royal says, reset is right. It's not our parents' housing market. Of course, things cost more, but not double in the last 2 years. Yeah, you're right. Carson says houses cost the same, but are more expensive, if that makes sense. Yeah. So usually the theory is as rates go up, the overall value of the homes will go down. And I think there was only one or two like real times in the housing market history where real estate prices actually like cratered, went down, and that was 2008. Usually what happens is the market will slow and the cost of real estate or the valuations of real estate you just won't see those egregious jumps in price, right? So in 2020 to 2021 and to the first part of 2022, what we saw is 17% year-over-year gains in housing, 20% year-over-year gains in housing. I don't think we'll ever see that again. We'll either probably have a flat market or a market that goes up 2%, 3%. But I think the amount of aggression that the Fed is taking here, and one other point that I wanted to make, if you think about it, just think about it like this for a second. Even with this big 75 basis point rate hike that everybody's talking about today, the Fed funds rate is still only at 1.5 to 1.75%. That's still really low, guys. And with that, and the Fed just started quantitative tightening, which we've talked about. June 1st was the official start of QT, in which case the Federal Reserve will start to unwind or shrink the size of its balance sheet. That started literally 2 weeks ago. And the market, the NASDAQ, is already down 30%. The S&P 500 is already off 23%. So maybe the market is trying to look through all of these rate hikes, and I think the market will bottom before the Fed finishes all their rate hikes. But I think we just need to keep that into perspective, that if the Fed is committed as they say they are, which I actually think they will be as committed as they say they are, rates still have to go a lot higher. There's going to be a lot more hiking coming down the road and a lot more unwind of that balance sheet. Hey, Armor Knight is here. Good to see you. Thank you so much for the support and becoming a member. I appreciate you very much. Diane Van says, hey Tom, my first home loan in the early 80s had a 22% interest rate on a 40% loan to value on a 40% loan to value ratio. Wow. Yeah, so Diane, I mean, you bring up another really good point. On a historical basis, could you imagine locking in a mortgage interest rate at 5%? You know, many of you here in the chat may have locked in loans at 10%, 11%, 12%. So that's also a good point. Rob DeCaro says, good evening. I am watching The Family Feud. Very nice. And I'm having macaroni salad. Awesome. Love that. Please get better, my friend. But Armored Knight, it's always good to see you. Wanye Cass says, hello, Tom. How are you tonight? I'm doing really good. We're starting the stream off from a little bit of a different location. We started the stream off from 110 Wall Street, which is almost where I used to work, near my old office. Sean Connolly says, how high do you think interest rates will go? Well, the Fed funds rate, it's projected by the end of this year, it goes to 3.4%. That's the projection that we heard from the Fed today. I think it'll probably get there, but we have to understand after today, right? Originally, the Federal Reserve was going to hike rates 50 basis points. That was the original plan. But last week we got a hotter than expected CPI print, so the Fed had to take more aggressive action and raise rates 75 basis points. I'm not sure what's going on here. I think there was like a marathon or something. And let me know, guys, if the wind is affecting the mic, because there's a ton of, it's really, really windy down here today. So just let me know. But to answer your question, what do I think interest rates are going at the Fed funds rate? By the end of the year, Jerome Powell said they're going to 3.4%, which is also historically relatively low. But this is sort of what I'm trying to piece together here. This is a really fun area down here. This is awesome. And I was talking about this with a friend today. What I'm trying to piece together is, my thoughts are that the market will probably bottom before the Fed is done hiking, because I still believe that the market is a forward-looking indicator. So the market is trying to see through all these rate hikes, and I think that's why we're seeing the pace of this sell-off, the velocity of the sell-off is so great, because usually the market is like, okay, let's price all these rate hikes in now, and then the market tends to bottom before the Fed is finished hiking. Additionally, before I forget, Stanley Druckenmiller, love the FDNY truck, by the way. Big support for the FDNY, love that. So Stanley Druckenmiller came out last night. It was either last night or early this morning, I forget. I saw it on Twitter. And he said something along the lines of, just let me cross the street here. He said something along the lines of, when you have inflation historically ramping like it is here, the market will not bottom until rates normalize. So as a little bit of homework, Armor Knight says I can't hear any wind on your mic. Oh, I thought you said you can't hear me. I was going to change it. As a little bit of homework, go back and check out what the normal, and I'm doing air quotes here, normalization is of the Fed funds rate. Ruby Falcone says love the FDNY. You know, I do too. You know, on some of the trucks that they have all very awesome like artwork. So I'm not sure if anybody's ever been past the FDNY Firehouse in Chinatown. Maybe we'll actually walk past there today, but amazing artwork on the trucks and on the door of the Firehouse too. But for now, we have to continue on our walk to the Brooklyn Bridge. Hey, Michael Chin is here. Hey, Michael says New York City has the best and the worst. A city of extremes. I can handle the challenges born and raised in New York. Yeah, I agree. I love New York too. Yeah, New York does seem to have the best and the worst. You know, it also seems like New York is like a very love-hate relationship, right? So it doesn't matter how horrible the politics can be. It doesn't matter how dirty it can get sometimes. I think there's always going to be people who want to live here, to be honest. Diane Van says, what if you were buying in a solid location and you were going to stay in it for several years? 3.4% is reasonable. Yeah, so I'll just give you an example. I think I could use myself as a good example. I purchased my first investment property last year. I can't believe it's already almost been a year. It feels like it was yesterday. I guess that's how much time flies. But the rate I got was right at around 3%. I think it was 3% right on the nose on my mortgage. Now, historically for that particular neighborhood, I think the home price was elevated, but here's the reason why I bought it. Historically, those type of properties weren't really used as investment, so I converted it into a legal two-family. So let's say I bought the place, I won't give the exact number, but right around maybe $395, $400. If you put 25% down on that place, I leverage out the rest, or I acquire debt for the rest. On 3%, my thought process is, okay, if inflation at the time, CPI at the time, I think was like 6%. Now it's 8.6%. It increased that much in a year. It's essentially free money, right? And if I have a tenant paying down the loan, how much did I really pay for the property? I paid $100,000 for the property, right? If I have tenants that are paying and take care of the property, and the property cash flows, which it does, I think the deal is worth doing. So one of my good friends that is in real estate, manages a lot, he's like, you can buy in any market conditions as long as the numbers work for you. I think where a lot of people get themselves into hot water is they don't focus on their own financial situation. Okay, they focus on what their friend is buying. Their friend just bought a 4,000 square foot house, and so I have to go out and buy a crazy big house too. Right, but if you focus on your own financial situation and you run your numbers, okay, and if you're going to use your house as an investment standpoint, where maybe you live in one of the rooms and you rent out the others, or you live on one side of the house and you rent out the other side of the house if you have a duplex or a triplex or something, so long as those numbers work for you and the property will cash flow, it doesn't really matter what type of market environment it is, because at the end of the day, it's not like you're flipping real estate around in your brokerage account, buying and selling overnight, right? So there's a really funny statistic that I read, and this came out, I learned this in my economics class in college. The vast majority of people will make money in real estate on their first home buy or first investment property buy, because it's harder to panic sell real estate than it is to panic sell stocks. And if you think about it, I mean, it's kind of true. And I think if you understand liquidity, which I think many of you in the chat understand liquidity, you'll understand what that sort of concept means. So if you have a downturn in the market where real estate prices take a hit 15 to 20%, it's not like you can go into your Charles Schwab or your Vanguard account and click sell, and then you liquidate the position immediately. It's a long, laborious process to try to get in and out of real estate, so it deters people from selling. So there tends to be longer holding periods to real estate. So there were people that bought at the exact top of the 2008 financial crisis, and now those people actually made money on their investment, even though they bought the top of the financial crisis, where real estate prices dropped 50%, and in some very, very niche markets, like the Vegas markets in Arizona, dropped upwards of 60%. Those people still made money if they held onto their properties. So I think it just really depends on your specific situation, if that makes sense. But guys, check this view of the World Trade Center out. Beautiful view. Absolutely beautiful here. Hey, Kilo Whiskey Juliet is here. Good afternoon, good evening. Estelle is here, says, hey, how's everybody doing? Estelle is joining us from Australia. Welcome. Hope everything is going well with you. Estelle, we're going to walk over the Brooklyn Bridge today. Always good to see you. Diane Van, good to see you, my friend. Says, by the way, hi everyone, just chimed in for a change. Yeah, more the merrier. Thank you for being here. James Brumley says, next year is going to be rough. Methinks, says James Brumley. Cynthia Beal says, my father always told us to buy a 2-family. I think that's a pretty good idea. Murky says, people always need a place to live. They can't live in their stocks. You know, that's a really, really good point. That's a good quote. You can't live in your stocks. You know, so there's always this, to your point, the number one, so if you think about like the hierarchy of needs, so this is sort of how I think about my life. So aside from an investment standpoint for a minute, maybe this is more philosophical, but for me, what I try to set up in my life, it's probably as young as possible, you need to get your hierarchy of needs in order and established. And I think the number one thing, in my opinion, some people will say, you know, food, water, all that, which I get. But you need somewhere to sleep. You need a place to live. So I think the younger you are, if you can afford to acquire a deal or get a property, I think that should be your first major investment. Because not only do you're guaranteed to always have a place to live, a roof over your head, a place where you can have clean water, not really have to worry about anything. But it'll also teach you about property management. So if you're in your late teens, early 20s, or even early 30s or whatever, if you can save up enough money for a down payment on a property, this is the Brooklyn Bridge, by the way. if you can save up for, hold on, we'll let this guy pass. In my opinion, if you can save up for a down payment on a house, and let's say you're in your early 20s, you can live in one of the rooms, rent the other rooms out. Over the course of the next 15 to 20 years, you haven't really paid a dime towards your house. You've had somebody else, a tenant, pay for essentially your house for you. And I think the younger you are, the more you can inconvenience yourself, right? And as you learn to manage and operate a property, you know, when the sink is, when you have a leaky faucet, if you own it, you're forced to fix it yourself. So you have to learn how to do that. Maybe you have an electrical problem, so maybe you learn how to figure out the electric on your own, or hire somebody to do it and watch them and understand the processes of how to do that. So I think from that standpoint, if you could solve that like hierarchy of needs first, I think that'll always be a good investment for you, especially if you're having somebody else essentially subsidize the cost. I think it's a good learning experience and a great investment too. Hey, Wise Guy, good to see you. Drake Smith says, good evening, sir. Good to see you, Drake. Wise Guy says, I just got here by clicking on a fake Robux giveaway stream and then click this. I didn't stay on that stream though. When I saw this, I immediately clicked it. All right. Tom M.
But maybe, you know,
says, Energy Secretary Jen exercised 1.6 million in stock options with an electric vehicle tech firm. She and Joe urged action on climate change while Americans face $5 in gasoline. So I don't really know anything about that, but we talked about Congress people trading before, and I think unanimously everybody agrees that they shouldn't be able to trade. But speaking of that, we had our first special purpose acquisition company, or SPAC, file for Chapter 11 bankruptcy. And I think many, many, many more SPACs are going to follow in short order in filing Chapter 11. I think this is a record for a company to go public and then file Chapter 11 bankruptcy, not even a year later. Yeah, Noodle says, hey Tom, are you walking the Brooklyn Bridge? Yes, we're going to go over the Brooklyn Bridge. Today's topic for tonight's stream, for anybody who's joining, is we're talking about the conclusion of the FOMC meeting. We're talking about Fed Chairman Jerome Powell's speech that he gave, in which we got a 75 basis point rate hike, bringing that federal funds rate to 1.50 or 1.5% to 1.75%, which is still actually historically low. The guidance. So here's another thing I thought was a little weird, really quick. So Fed Chair Jerome Powell came out and said that we do not expect to have to go big with another 75 basis point rate hike. But going forward, we think the rate hikes will be in the range of 50 basis points to 75 basis points. Like, that's exactly what he said. So, I mean, isn't that the same thing? Anyway, but at the end of the year, the Fed funds rate is projected to be at 3.4%. And if that happens, I think it's a pretty good possibility that a 30-year fixed rate mortgage could be bumping up towards 9 or 10%. And Fed Chair Jerome Powell said something very telling about the housing market specifically, and I'm paraphrasing here. I think there's a big party going on at Pace University. Maybe it's like a graduation orientation thing. So this is Pace University here in Lower Manhattan.
You ready? Pace University! 1, 2, 1, 2, 3, go!
Let's see. Hey, Gregory's here. Good to see you. FHL says this is one of the best live streams. Thank you, Tom. Thank you, FHL. Cynthia Beal says, I saw a comment today about the rate rise. You cannot catch a speeding train at the same rate. You have to go faster. 75 basis point raise may not be enough. Yeah, so I do understand that. But at the end of the day, you can't cause like a massive shock to the market. But then again, Cynthia Beal. So Cynthia Beal, you are in the camp with Bill Ackman. So we talked about how Bill Ackman came out yesterday with a tweet saying that the fixed income markets and the equity market have totally lost confidence in the Federal Reserve, and the only way to restore that confidence is for the Fed to raise interest rates by 75 basis points, or what would be better, do 100 basis points and do a full percentage point. But look, I think it's easy for everybody, including me, if you guys have been watching this stream, you sort of know my stance. I can, really ream into the Federal Reserve, but I think it's important. I was thinking about this today. I think over the past couple weeks, I've been giving one side of the argument a little bit too much. So I think when you're developing a thesis like that, I think it's important to try to make the base case on the other side. So what do I mean by that? Well, I'll tell you what I mean. I think everybody knows the distinction between fiscal and monetary policy. Okay, and for those of you who don't, we'll just do a quick recap. Fiscal policy is the policy that is set by the government in terms of the government spending American tax dollars, right? That is the fiscal policy. So spending in that regard. But on the other end, monetary policy is the policy that comes out of central banks, such as the Federal Reserve, from Fed Chair Jerome Powell and the like. So I think over the past couple weeks, I've been leaning into the monetary policy side of the house, maybe a little bit too much. And I kind of caught myself doing this today. I was like, I understand that the Fed, and I agree with the End the Fed movement, but I don't think we can let our politicians off the hook. And I want to know, you guys comment in the chat. Do you think I'm off base here, or do you think I'm right? I'm totally willing to hear out other ideas. But at the end of the day, Republican and Democrats, I think since 2008, I think they share in the blame of absolutely egregious fiscal policy. It was even really, really horrendous under President Donald Trump. I think it's equally as horrendous under Joe Biden, because we've literally provided people with helicopter money. Now, I know that it was a very, very 1 in a million pandemic style scenario that we've really never faced before, and I get that. But we cannot expect to literally send people checks and money in the mail to spend and not have that cause inflationary pressure. That's number one. So I think that the fiscal side of the house also shares in some of that blame, but now let's walk and take that one step further. From all of the data that we're seeing, and even some of the data that I'm pulling out of my own life, you guys know I'm in enterprise tech sales. So a lot of the times when I work with big organizations and they want a specific product being built with custom applications, I have to go to an OEM, and many of these OEMs are actually overseas to procure these products and services. And the supply chain has been absolutely horrible. And I think that's no question. I don't think anybody's arguing that. So I think the vast majority, maybe, And again, tonight we're sort of exploring the other side of the argument, just so everybody hears both sides. I think the vast majority of the inflationary pressure that we may be seeing is simply just due to supply chain. And here's the reason why I say that. Looking at the CPI report, which we've covered, so just take that stream, maybe if you want to rewatch it. Take a look at the CPI report, but also pay very, very close attention to a lot of the earnings reports that we've been talking about. We've been talking about, hold on, somebody get away from the music. So I think that guy's selling like waters or hot dogs or something, but he's hammering the music. If I was hungry, I don't think I could even go up to the guy and buy anything, just because I'd get a throbbing headache from the music. But in any event, if we look at what a lot of these CEOs of these major corporations, the S&P 500 corporations, are saying, what they're saying is that a lot of their gross margins are compressing. And do you notice the verbiage that they're using? It's due to supply chain disruption. It's due to the zero COVID policy in China that is also exacerbating the supply chain issue, right? So imagine if we could solve I gotta watch that guy. Imagine if we could solve the supply chain issue globally. I think there's a pretty high possibility, a very high possibility, that that could single-handedly cut the inflationary pressures in half. So that's the other side of the argument. So the point I'm trying to make is I understand the End the Fed movement. I'm the first person to criticize the Federal Reserve, but I don't think they're the only people to blame here. I think that fiscal policy has also contributed to inflation. And then on the other hand, undoubtedly, supply chain issues have also contributed to inflation as well. So what do you guys think about that? Hey, it's Upstate Albany Walking Tours. What's up, dude? Says hello everybody, and hopefully you're having a great day. Long time no see, hopefully you're well. Flat Smack, good to see you. Here, I'll give everybody a view of the onboarding ramp of the Brooklyn Bridge. 3T3 says agreed, good to see you. Brian Forrest is here. MK says hello, this is my first time. Well, MK, thank you for joining. It's a pleasure to have you here. And hopefully you had a fantastic Wednesday so far. We're walking the Brooklyn Bridge. It's a beautiful night, very clear. So as we get halfway over the bridge, we're probably gonna have a really nice view. Probably gonna have a really, really nice view. Ren10 says the fiscal policies from 2017 on were too loose. Yeah, Ren10, I agree with you. And, you know, a lot of Republicans, sorry everybody, I'm battling allergies, I apologize. And a lot of Republicans get upset with me and they start freaking out. You guys know me. In full transparency, I tend to lean more conservative. I do. But everybody's opinion is welcome here. So here's where I had a big problem with President Donald Trump. I had a major problem with that because he spent so much money. And obviously as a conservative, knowing that a Republican would spend that much money, that's why, you know, I sort of coined the phrase that the Democrats, or the Republicans are now the Democrats and the Democrats are now the socialists. There was nothing conservative about Donald Trump from a fiscal policy standpoint. But again, that's not to get the chat riled up. It's just to state a fact as we're talking about inflationary pressures potentially caused by fiscal policy. The Biden and Harris administration also egregious with the fiscal policy, in my opinion. And again, we're looking at this from a financial analyst point of view, not let's argue in the chat who's a better president. We don't care about that. in finance, our job is to make money and capitalize on the market. So totally set your emotions aside for this chat. It doesn't matter if you are a Biden supporter or a Trump supporter. It doesn't matter. And quite frankly, I don't care. But the point we're trying to make, since the topic of the stream is the Federal Reserve raising interest rates 75 basis points today, maybe we should give Fed Chair Jerome Powell and the Federal Reserve a little bit of slack. Maybe we should cut them a little bit of slack. And I'm the first person, you guys know me, I'm the first person to really hammer on the Fed, but I think they share in the blame of incompetent fiscal policy and, undoubtedly supply chain issues from COVID-19, undoubtedly. Fredex says, meet the new bosses, same old bosses. Jetstar says, Biden is crushing our economy. Flat Smacks says, sounds about right. Ren10 says, you just stating facts, no one can argue with that. XXX says, Tom, the Dems are not socialists, they are fascists. Let's try to, I understand both sides of the argument, I get it. Porkline says, Trump is a Republican on Monday, a Democrat on Tuesday, and a fool on Wednesday. That's okay. That was a funny comment. I could laugh at the comment. That's a funny comment. Jerome has no backbone. Look, so Emmanuel, I actually thought he did an okay job today during the speech. But did anybody notice? And I'm not a big I think analyzing the body language, I think that's a lot of nonsense, to be quite frank. But did anybody see Jerome Powell's hands shaking at the beginning of the speech? He was literally shaking the papers like crazy. And I understand because I think he has the single most stressful job above President Joe Biden. I think it's harder to be the Fed president or the Fed chair than I think it is to be the actual president of the United States. I think the hardest jobs in the world is number one, the Fed president, and number two, the president of the United States. And here's why I think that, by the way. Here's why I think that. Because when you're the president, and if the economies go south, you could always blame it on the Federal Reserve. Right? I mean, that's what President Trump would try to do all the time. He says, hey, Powell, if you raise interest rates, I'm going to fire your ass. Excuse me for swearing, but that's what Trump would say to him. So Trump was almost bullying to say, look, if you raise interest rates on my watch, you're going to tank the economy, you're going to tank the stock market, and that's not going to look good for me. And that goes back to my other point, which we've explored on the stream before, to say I really don't think that the president should really take too much credit for the performance of the stock market, because ever since the lows of 2008, the people who are or the person who is responsible for the stock market performance with about a 90% correlation is the expansion of the Fed balance sheet. So there's data out there right now. That says since the lows of 2008, which was the great financial crisis, as the Federal Reserve's balance sheet expanded, so did the returns of the S&P 500. So the S&P 500 would go up every time the Fed would expand their balance sheet, and every time the Fed would contract their balance sheet, which they're doing right now, by the way, stocks would go down. So I think the Fed sort of has to take more responsibility on that end. Zabatata says he was probably cold or hungover after Trump. That man is a stone-faced killer. And everything he said was already decided a long time ago, more or less. The Tripod said his dad doesn't need to know where he lives because I don't get it. Leary says, good to see you. Pork Rind says they even blame Joe Biden for the baby milk formula. You can't make that up. So I won't go that far. I think the oil and gas prices you can blame on horrible government policy. And that is the truth. Because there's not, so ExxonMobil, I'm not sure if anybody saw this. So essentially, and I don't really want to go too far down that rabbit hole because I kind of want to stay on topic tonight. But ExxonMobil, check out, if you want to look on my Twitter feed, I actually retweeted the letter that ExxonMobil put out in response to the Biden administration claiming that it's all the oil companies and the oil refineries' fault for oil and gas being so high. Go check out my Twitter page, @WalksWallStreet, and read the response that ExxonMobil gave to the Biden administration. That's sort of as far as I'll go into that. Hey, Snoopy says shout out to Brew and Beyond Long Island. Good to see you. Patrice Ivory says, why are we even talking about Trump? He's no longer president. Yeah, so the reason why we were talking about Trump is because Fed Chairman Jerome Powell raised interest rates 75 basis points today. And as you know, Patricia, we've been talking about on the streams a lot that I would always say the number one driver of inflation is the Federal Reserve and their monetary policy. So tonight, I wanted to try to take the other side of that argument to talk about what part of fiscal policy or what part in inflation does fiscal policy share? Because there's a distinction here which I think a lot of people can often conform or merge into one. So fiscal policy is how the government or administrations choose to spend American taxpayers' money. But monetary policy is the policy set by the central banks, right? So essentially what we were saying is that I think it's very possible that inflation, we're just starting to see the effects of inflation hit right now. Because during the pandemic of COVID, we had to spend so much money and actually send people checks, send people $800 to $3,400 checks in the mail, and that wasn't the fault of Fed Chairman Jerome Powell. Okay, that isn't the monetary policy side of the house. That's the fiscal policy side of the house. So I think I may have been a tad bit harsh on the Fed, even though I think they deserve a big blame in this. I also believe that government policy and government spending contributes to inflation maybe a lot more than I'm giving it credit for. So that's sort of why we were talking about President Trump, because obviously in 2020, when COVID hit, he was our president. And then rolling over into now, the Biden administration is also continuing very, very large amounts of government spending. So that's sort of why we were talking about that. But good question. It's a good question. Fed Wang says fiscal policy job is 90% Congress approval, 10% White House's suggestion. Very good point. So maybe we could refine that. So let's say our politicians. How much do our politicians share in the blame? So let me read some of the comments. But everybody, we are at the top of the Brooklyn Bridge. It's an absolutely beautiful night here in New York City. And we're going to see an amazing, amazing view from the top of the Brooklyn Bridge. Hey, Samantha R says, even this view is beautiful. I love to see the bridge in the nighttime. So if you look into the distance, this is actually the Manhattan Bridge. And we've walked over the Manhattan Bridge before on the stream as well. Christina says, Tom, why do you predicate the inflation solely on the stimulus checks? So not solely on the stimulus checks. I was just making one small example, right? And I think that's the biggest example that we can make. So when I talk about the difference between fiscal and monetary policy, I think that example resonates with everybody a little bit more in the chat. But to your point, there's definitely a lot more examples than just the stimulus checks. So you're right about that. I was just making one in particular point about it. A very good point. Hey, British Grey is here. Good to see you. Welcome. So check out this view of the World Trade Center from the Brooklyn Bridge. Beautiful out tonight. Hey, Victoria's here. Says, I'm lapping this up. Love this bridge. Yeah, if you haven't been to New York City, I think one of the things that you really need to do is just walk the Brooklyn Bridge during the day and then come back at night and re-walk it, because it's sort of strange. I can't explain it. The view actually does change from the daytime to the nighttime. I don't really know how to explain it, but it's beautiful. Hey, Bagels and Walks is watching you on my walk home. I was just at the Central Park for the fireworks. Hey, I saw that on Twitter. I wish I could have went there. Not gonna lie. Hey, the RT440 says, Tom, Reagan had huge deficit, Bush had huge deficit, Clinton balanced the budget and had a surplus, Bush Jr. had a huge deficit, Obama cut the deficit, Trump had a huge deficit, Biden is cutting the deficits, is the RT440. Thank you for that information, RT440, and thank you for joining the chat tonight. So guys, check this out as well. I'm going to zoom in on the Empire State Building, which I'm not sure why is lit up all green tonight, but it looks beautiful, doesn't it? Matthew says, why do people's messages keep getting retracted? Just curious. I'm not sure, but I do notice the chat is flying. I'm not retracting any messages though. Hey, this is, hey Tom, my move to New York is next Friday. I'll probably be super busy before exploring, but any recommendations of stuff to do on July 4th? I would recommend watching the fireworks from Brooklyn. So I'm actually probably going to be in New York City for the 4th of July. Oh yeah, everybody, if you post any like expletives or emojis in the chat, the Nightbot does remove it, so just keep that in mind. Hey, Monica B, it's always good to hear your voice, Tom, and have a beautiful night in New York. Thank you so much, Monica B. Oh, Noodle says I retracted a message because I spelled something wrong. Copy that, 10-4. Copy that, everybody. But yeah, so the comments are really rolling by here. But again, I just like to gently make the notion that I know a lot of people in the chat are getting very politically charged. When we're talking about politics on this channel, it's coming from a financial analyst's point of view. And if let's say if you're running a $30 billion fund or something like that, you don't really care about the politics so much, you care about making money. So when we talk about fiscal policy and things like that, the point is not to say Trump's a bad guy or Biden is a bad guy or the Democrats are bad, the Republicans are bad. It's to analyze the data and say, from this data, how can we put together an investment thesis to generate alpha? So just sort of be cognizant of that as we're talking about that, because I don't think it's helpful to argue about the politics, because just to be very blunt, I really don't care. I just care about analyzing it in order to make a lot of money in the market. Fed Wang says, yes, we want the problems fixed. We do, but my channel is not about That's really not what my channel is about. There's many channels on there, like the Young Turks you could watch, or Ben Shapiro, that analyzes a lot of that and tells you guys if it's bad or not. We just sort of talk about these things from a perspective of how it affects the financial markets. So guys, check this out here. So what you're seeing is the One Vanderbilt building, which looks amazing. This right here is the 432 Park Avenue building. And the one on the right is the Chrysler building. Man, that's a beautiful view. So from the top of the Brooklyn Bridge, you can almost see everything. It's hard to focus here because I don't know what the depth perception here is a little bit weird. So hold on, let me turn the brightness up on my phone. I know I'm probably making you guys dizzy, but I don't know if the phone is focused or not. But we are at the top of the hour, everybody, so we'll just do a quick recap for the people that are coming in. Obviously, today was a big day on Wall Street. We heard from the Federal Reserve, so the FOMC meeting did conclude today, in which case Fed Chair Jerome Powell did address everybody at his speech, in which case the Federal Reserve is going to be moving forward with a 75 basis point rate hike. Now that is going to take the federal funds rate to 1.5% to 1.75. And he gave projections that by the end of the year, the Fed funds rate should be roughly around 3.4%. So to give some context on that, as of right now, as of recording, a yield on the 30-year fixed rate mortgage is now above 6%. Fed Chairman Jerome Powell also gave us a little bit of insight as to what he thinks about the housing market, or how higher interest rates can affect the housing market. And he sort of gave a little bit of a dodgy answer, and I thought it was very thought-provoking. So I'd sort of like to explore that in tonight's stream. Essentially what he said is, if you're a young person in America, you're going to want a reset. He said if you're a young person in America looking to buy your first home, you are going to want a reset. And essentially the way I took that is, as interest rates go up, Fed Chair Jerome Powell is predicting that we should see a significant decline in the valuations of homes. Now, I don't want to put words in his mouth, but that is sort of how I interpreted it. So if he gets a question and he's asked, what do you think about the future of the housing market based upon the monetary policy? And he says, I'm paraphrasing here, by the way. So this isn't exactly what he said. I'm paraphrasing. He said, if you're a young person in America trying to buy a house, you're going to want to reset. Which, let's take all emotions out of it. At the end of the day, isn't he kind of right? And this is coming from a person who bought an investment property last year. The average American, especially if you are, let's say, in your mid-20s or early 20s, it's very hard for you to get a home because it's just so expensive. I mean, a starter home could be anywhere between $400,000 and $500,000. And right now, those prices have not come down yet. And interest rates are at 6% or above. So that means the cost of your monthly mortgage payment has essentially went up 100%, assuming if you wanted to buy the same house just 3 months later, which is right now. So what do you guys think? And I want to know I really want to know what you guys think. I've been talking a lot tonight, so I really want to know what you think. Do you think that the parabolic move in rates will cause a steep decline or a crash in housing? Let me know what you guys think in the comments. I'd love to know your thoughts. Hey, the LT Prod says, hey Tom, Redfin announced layoffs. Yeah, you're right. So that was another company that just recently announced layoffs. You're right about that. Hey, Ramsey says, hey Tom, what's up? Best greetings to everybody. Tom, do you remember where I'm from? Ramsey. Ooh, Egypt. Snoopy says, do you think this is a good time to buy a house or wait? I'll address that question in a second. Arsenal Fan 13 says he does have a point. Housing prices and rents are absolutely bananas all over the country. I think it will cause a correction but not a crash, says Arsenal. Interesting. Bruce Wayne says US is walking into socialism. Hey, JL is here. Says, hello Tom. I know you're talking about starter homes. Young people don't realize that you don't get much square footage for 300,000 or 400,000 either. Yeah, you're right. You're right. NE says, I honestly think the hotspot areas, specifically in Florida, Texas, Arizona, Nevada, will continually rise. Interesting thought. Rocco DeLeo says, I think a crash comes from lack of credit worthiness and the ability to pay back your mortgage. So not something I think will happen in the near term, but certainly a reduction in housing prices should, ... I think you're going to finish your thought. All good comments. I'm trying to read the biggest ones, but Jetstar says the housing market in the southwest of Florida has come to a halt. Somebody says yes, huge crash. Christina. Okay. So it looks like we're about split 50-50, to be honest, in the chat. Which, if we think about what a traditional bell curve should look like, that's actually pretty normal. So it looks like we're split 50-50. It looks like some people think we're going to have a full-on crash. It looks like some people are going to think we're going to just slow down a bit. I'll give you my thoughts in a minute. But everybody, if you like the topics that we discuss and you want to support the channel in a free way, I do write a free investing newsletter every other Tuesday when the market closes. So we talk about not only the US equity market, we talk about emerging markets, fixed income. So if you want to be a part of it and stay up to date on the markets, feel free to scan the QR code on your screen and you could sign up for the Behind the Street newsletter absolutely free, where I will share my equity research with all of you at no cost. It's a great way for you to support the channel, absolutely free. And if you are new to the channel, feel free to leave a like and subscribe if you are new. Bagels and Walks says, Tom, what cell network are you using? I am using Verizon. Hey, the ABX girl is here. Welcome. Bruce Wayne says, you want to live in Manhattan doing dog walking with a degree in gender studies? Oh, if you have that, it's going to be expensive? Okay. Line Sync says, I've been here for several minutes, but too busy cooking to be able to comment. No problem. Good to see you, Line Sync. Twitch ASMR says, once people lose jobs, foreclosures will start. Savings will diminish and inventory will rise. Perfect storm, buckle up. So Twitch, that's actually a very good comment. I want to explore that as well. Because Twitch, you're right. We are starting to see a lot of layoffs coming down the pike here. So we'll explore that in a minute. But that's a very good comment. Very good comment. Craig M says the top 10% will be fine and everybody. Cost of living will continue to rise massively. A new tax on the middle class. NBA Elias says credit card debt is the untold story of today's and future Fed hikes. Debt will get worse and will affect spending in the future. Very good points, everybody, I'm seeing in the chat. Matthias, I'll get to your Twitter deal in a second. 1 second. Mike says, can you go to Bensonhurst, please? Not tonight, to be honest. Not tonight. So here's my take. Not to sort of play the fence here, but I do think a lot of people in the chat are making very good points. Here's where I think I have a little bit of a twist on my thesis. I don't think we will see default rates at the velocity as we saw in 2008. That I don't think so. That I don't think so. Additionally, here's what I think could possibly be total speculation. And my worst case scenario may not be what you think. My worst case scenario may not be what you think. I think the worst case scenario for housing in America would be a minor correction of 10%. Now you're probably saying, wait, why is a minor correction of 10% a bad thing? Well, I'll tell you why. And you guys could feel free to disagree with me, and I'd love to know why. But if the stock market, if the housing market only corrects a mere 10%, but the rate on a 30-year fixed rate mortgage continues to go towards, if the fixed rate on a 30-year mortgage continues to go up towards 10%, that means the middle class will be completely and totally priced out. So I'll say that one more time. If we only have a mere 10% correction, that's actually going to be worse, I think, on the middle class. Because if rates go to 10% on a 30-year fixed, and housing prices only come down 10%, or let's say maybe even a little bit more, okay, we'll give it 10 to 15%, affordability will still be worse than it was 3 months ago. So what does that mean? That means the people who will be able to buy in that market will be very, very well capitalized, institutional investors, and private equity. Why? Because they now get to buy real estate at a 10% discount, but they're not going to pay the interest rate. They're going to buy it all cash. And that's why I think if you look at the vast majority of people who bought when interest rates were artificially suppressed, guess who it was? That were taking on monstrous amounts of debt at extremely, extremely low rates. So they're renting, so long as the renter can continue to pay their rent, institutions should be fine. But if we just get a bit of a slowdown in the housing market and only a mere 10% correction, it'll still be more expensive to buy a house because your monthly payment is going to be higher on the average guy or girl who's in the middle class. But an institutional investor could say, hey, this is perfect. Real estate prices are down 10%. Let's do another raise and buy it cash and get it 10% lower. Then, as we head into the 4th year of the Biden presidency and we get inflation under control, interest rates will start to go down again. The Federal Reserve will start quantitative easing, and guess what? When institutions just bought on that 10% dip, those housing prices are going to go up 30%, rates are going to drop to 3% again, and they're going to sell the middle class back their houses that they just made millions on. Again, that is all speculation, and that was one of my many theses I'm coming up with, but that's essentially the reason why I think a mere minor correction in real estate may be the worst possible scenario for the middle class. But guys, check this out. In the distance here, you have the absolutely beautiful Statue of Liberty. You know, it's so amazing up here on the Brooklyn Bridge. So right here is the Statue of Liberty. Beautiful. Hey, Hemp Lord is here. Good to see you, Hemp Lord. Welcome. Hey, Tech Explorers NYC. Good to see you. So except the signal cuts out a bit. Dr. Longus says, interesting thesis. Tech Explorers NYC says, no, I totally believe you. The middle class is getting fleeced again. So I actually think, so Tech Explorers NYC, if we have another like major decline in housing, I think that for the long term, if the economy goes into recession, if we're thinking on a 20-year time frame, I think that would be the best thing for the health of the economy in 20 years. Hey, Muhammad is here. Muhammad Ali says hello from Fort Wayne. Good to see you, Muhammad. Thank you for being here. Ruby Falcone says, don't poke your finger on the spike. Funny. Mr. Ming says, fun fact, the main frame of the Statue of Liberty was designed by the same man who designed the Eiffel Tower. Very cool. NMB045 says, I believe the biggest consequence of all our economic problems will be no traditional fixed date retirement. Years old and progressively part-time as we get older. Interesting thought there. So I know that tonight's stream may have came off as a little bit of doom and gloomy, but now as we move into the second hour of the stream, I'm going to tell you why it's not. I'm going to tell you why it's not. It is indisputable that the quality of our lives over the past 10 years has gotten exponentially better. Just think about your life 10 years ago and think about life right now. As a very small, minuscule example, this live stream would not be possible like this 10 years ago. Just 10 years ago. Think about all the new technological innovations that happened just over the last 10 years. You know, think about cellular phones, being able to communicate with your friends and family over FaceTime and other things like that. Remote work, you know, having the time to work remote, having more time for yourself. You know, you look at the average car right now as opposed to the average car 10 years ago. These things are like spaceships if you've ever been in a brand new car. So I think the pace of technology that is accelerating, it's making our lives a lot more convenient. I think oftentimes we just don't realize it because over a 10-year time span, you could start to get that little bit of lifestyle creep where you don't really see the change unless you really take a step back and think hard about it. And I think over the next 10 years, we are going to have such a technological boom in the United States and around the world. We're going to have new advancements in healthcare. We're going to solve the climate crisis. I can almost guarantee you we're going to solve that within the next 10 to 20 years. We're going to solve the affordable housing crisis. I guarantee it within the next 10 to 20 years. Because no matter the climate or the environment, entrepreneurs wake up every single day and work on creative solutions to problems. Just look at Tesla. I mean, we didn't have EVs 10 years ago. Now it's projected that by 2025, the vast majority of all cars that are sold will be EVs. So I think if you could zoom out and put on your optimism hat and just think about what you guys do every day. I'm sure every single one of you get up and go to work every day and build something. Maybe you're an entrepreneur. Maybe you're building a new software. Maybe you work in the medical field. Maybe you're a doctor where you're currently seeing new medicines come out that are helping your patients, right? And those innovations are not going to stop. It's perpetual. It's never going to end. So even though things may seem crazy and scary and we're going to have more booms, more busts, more Great Depressions, out of every single Great Depression America has been through, we've come out on the other end much, much better off than we went in. and that is just a fact. Sunshine after rain is like optimism hat. I like that one too. Hey, Bot says, why USA doesn't allow more techies while there is a shortage in the industry? Bot, that's a really good question too. That's a really good question, and I think that's one of the biggest mistakes that America is making right now, is not granting more H-1B visas. So I think you're right. Bruce Wayne says, optimism sucks, pessimism is for cowards, no feeling when trades. Bruce Wayne. Yeah, the LT Prod says the economic slowdown could help semiconductor supplies to catch up. You're right. I mean, Apple right now. So Tim Cook announced that he is actually readjusting his supply chains away from China because due to the zero COVID policy over there, a lot of the factories are shut down. So they're actually moving a lot of the production to other countries. Matthias says, I think that in 10 years, the housing market is going to be based on smart housing. Elon Musk has started to invest in that industry, and I see a future. Imagine a house for only $50,000. I actually agree with that a lot. Tech Explorers NYC says, why should we import talents? Because we don't want to train our own. Well, there is an undoubtable shortage there. But to Tech Explorer NYC's point, that's just, not to go back to what Fed Chair Jerome Powell said, but he talked about the labor force participation rate in relation to the unemployment rate. We're gonna walk back across the bridge, by the way, everybody, just to let you know. And right now, we've seen no notable movement in the labor force participation rate, which is, I think, more important than the the unemployment rate, which I think is more important. The ABX Girl says, also IBM and other companies do not want to interview talented people over 40 in IT. You are done at 50, says the ABX Girl. Really? Isn't that illegal to discriminate based upon age? But maybe you're right. I haven't experienced that, maybe because I'm not 50. But I'm not going to say you're lying. I'll take your word for it. Jetstar says, SpaceX a gimmick, think not. Steph writes, his World Trade Center looks pretty. Yeah, it looks beautiful. I'll show you guys a view of the traffic, but if you're enjoying the stream so far, everybody, feel free to give a like on the video and subscribe if you are new. Gregory says it's illegal, but people still do it. Understood. Understood. Look, I think there's a lot of good ideas circulating in the chat. A lot of thought-provoking ideas. Dr. Longus says, yes, the participation rate. Cindy Foley says, Tom the optimist. I always try to be an optimist, always. I've never met, out of all of my really, really wealthy friends, not one of them is a pessimist, not one. Robert Rod says, entrepreneurial spirit and solutions are stifled in Hawaii. Labor and government unions call the shots. And yay or nay, heavy taxes and regulations, says Robert Rod. Thank you for that insight. I had no idea about that. But that's awesome that you're from Hawaii. I think you're our first Hawaiian viewer. Hey, Silent, good to see you. Says, hey, Tom, what do you think about the coming heat wave? I didn't know we had a heat wave coming, but that's good because I love it hot. I really, really like it hot and humid. Craig M says, companies like Uber and DoorDash, biggest innovations by passing workers' rights by pretending their employees are subcontractors. I would give subtle pushback on that, but Cindy Foley says, my daughters are in New York City tonight to see Paul McCartney tomorrow night. Hey, well, please tell them to be safe and have a good time. And welcome to New York. But you know what, guys? Not for nothing. It's actually kind of chilly out tonight. not gonna lie. I'm actually a little bit cold up here on the bridge. Hey, Ed Podke is here. Says, hey Tom, good to see you. Ed Podke is joining us from Corning, New York. Good to see you, Ed. Always a pleasure. Matthew is here. Hope you're well. Ruby Falcone says, time check 10:43. Yeah, we're gonna exit the bridge now and walk uptown. I'll give you guys one last view of Midtown Manhattan from the top. So if you see the big green building, that is the Empire State Building. Right to the right of it is the One Vanderbilt. And further right, you see 432 Park Avenue, and this little teeny building right here is the Chrysler Building. Yes, Samantha Ars is Swan. All right, so everybody, we will take a walk uptown. Hey, Kevin Sunderland, thank you so much for the donation, for the $20 donation. Thank you, Kevin. Says, Tom, not to sound insensitive to economic fallout, but a recession due to Fed tightening as opposed to financial crisis or global pandemic should be healthy reset to the economy. You know, I think you're right. Kevin. So first and foremost, thank you so much for the donation, and I think you make a good point. And we've been sort of talking about that in relation to the housing market, that I don't think we'll see like a massive wave of defaults like we did during the financial crisis. But the only thing concerning me about that is there was almost no bid in the MBS market 2 days ago, which was a little bit concerning. But to Kevin's point, ever since the financial crisis, it's almost been like America is not allowed to go through a recession. It's like anytime the stock market has a little bit of pain, anytime equity prices come down a little bit, everybody screams, everybody runs for the hills, and they pray for the Fed to lower interest rates and print a bunch of money. It's like we're never allowed to experience any pain anymore. But the reality is recessions are actually healthy and very necessary in an economy. And the reason for that is because if you never go through a recession, you're never going to have the proper flush out of money-losing companies that don't generate free cash flow. And over the past couple years, what we've created since we've kept interest rates artificially suppressed and printed a bunch of money is we've created zombie companies. So oftentimes on the stream, we'll talk about a lot of these Russell 2000 companies, which they're considered zombie companies. I've explained what that means before. I think it's going to be a little bit off topic for tonight's stream, but essentially the only reason why they're in existence is because of cheap money. They can borrow and borrow more money perpetually at low interest rates to service their existing debts. But as interest rates go up, a lot of those companies become insolvent. So I do agree with Kevin's point. I think recessions are absolutely necessary. Hey, JL says, love the Brooklyn Bridge. Good to see you. Welcome, JL. Nirvana Fan 500. So what times does the sun rise in New York this time of year? I'm actually not too sure, to be totally honest. I'm actually not too sure. Maybe somebody could Google that. Hey, Western Mass Dave, what's up? Jetstar says gallon of gas here is now $5.17 or $5.19. Wow. Van says, Tom, you said the vast majority of cars in 3 years will be EV. Not possible. Craigslist EV search, less than 27 owners, used car sales. No, so Van, I think you're maybe mistaking what I'm saying. All new car sales. So I think Ford's goal is by 2025 or 2026 is to have the vast majority of their new car sales be EVs. Not the majority of cars on the road, but if you walked into a dealership and you wanted to purchase a car, the goal at least is for about the vast majority of those new car sales to be EVs. So I think Ford said that, GM said that, and obviously Tesla. I mean, Tesla's at 100% of new car sales being EV for obvious reasons. Wow, I think this view is probably the best from this little corner right here. Divraj is the nice city in the world. I agree. Line Sinks is the just past full moon up yet in New York City. I haven't seen it. You know, I think last night was called, I forget the exact terminology of it, but it was something of significance. It was a beautiful full moon yesterday. You know what? The only thing about standing on the Brooklyn Bridge is it shakes. That's my only concern. Ah, MJ's is Strawberry Moon. Got it. Explorations is huge recall on the Ford Mach-E. You know, Exploration, what was the statistic that they came out with? I mean, not a statistic, but I didn't really have time to look at it today. But supposedly, due to supply chain issues, which is a good topic for tonight's stream because we were talking about inflation, but due to supply chain issues, Ford is no longer profitable on their new EVs. Supposedly they're profitable on the one of their pickups. I forget what model that's called. But due to supply chain and margin compression, they're actually underwater on it now. Sunshine After Rain says, Tom, you should have brought your board tonight. That would definitely come in handy. We do have a long walk uptown. But I'm going to take you guys with me. Wow, I think there's probably an accident on the highway here. Check that out. It's clear here, but on this side it's insanely packed. Gregory says, look at the Tacoma Narrows Bridge and then say there is shaking. I think I saw something like that on YouTube. That bridge that was going nuts. Hey, Daniel G is from Buenos Aires, Argentina. Good to see you, Daniel G. Hopefully you're well. We're walking the Brooklyn Bridge tonight. Somebody's asking how far uptown do we have to walk? We have to walk about probably 4 miles uptown. So we're going to go to Penn Station, New York City's Penn Station. NMB045 says, Tom, I'm sorry, but I can't wrap my head around how we're going to get all the lithium and copper for mass EV production. You know, another concern I have in relation to that is a lot of the rare earths that go into making a lot of these batteries and components for EVs. Unfortunately, they are not mined in a sustainable way. And what I mean by that is a lot of the rare earths are mined in like the Democratic Republic of Congo and things like that, where unfortunately they still use, like quite legitimately, child labor and even slave labor. So I think as a country, if we are going to really hammer on this EV mandate, we got to make sure we're sourcing our raw materials in an ethical way. That's my 2 cents on that. And maybe we are, and Elon Musk has talked about this as well. Investors Business Daily came out with a fantastic article talking about this a little bit and actually covering a couple companies that are working on this issue to potentially pivot from traditional lithium-ion batteries to newer technologies that may be a little bit safer from overheating and catching on fire and things like that. I think I actually sent the link in the Nightbot, but I forget what the command is, unfortunately. All right, so this is the FDR Drive North exit. So these are all the cars coming over from Brooklyn Bridge from the Brooklyn side over into the Manhattan side. FredEx, this bridge walk is now my top 5 of 4 streams for sure. Yeah, this is a good time. I love coming up here. It's a very good stream, I definitely agree. We got a long ways away, everybody, so hopefully you guys brought your walking shoes tonight because we have a long, long way to go. Yeah, I know Bagels and Walks, the bike guy was on the wrong level. So here's the bike lane, I'll show everybody. So they moved the bike lane from up top to down here, which I think was the right move, to be honest, because I'm not sure if anybody in the chat have been up to the Brooklyn Bridge before they moved the bike lane to the lower level, but it was an absolute horror show. Talk about a nightmare. You had all the pedestrians walking and bikes and scooters whizzing by here, blowing by here like 20 miles an hour, super dangerous. So I think it was a good call by the city to make a dedicated bike lane down here on the Brooklyn Bridge. Cindy Foley says, Tom, do you get tired of walking? No, it's weird, I don't. It's almost, and this is serious, I'm not trying to be funny. It's almost like when I stop walking, that's when I get tired. It's almost like my batteries are charging as it's moving. It's sort of like a bicycle. When you pedal the wheels, it charges the battery on the bike. So as long as I keep walking, I'm good. I'm good to go. And that's why I think it's good that my phone battery dies right around the 2.5 hour mark, or else we'd be streaming for 5-6 hours. Matthew says no because he's 27. Yeah, maybe that's why. Maybe that's why. Hey, Noodles says, Tom, I'm watching on my TV and chatting on the phone. So how does it look if anybody's watching the stream on the TV? I'm curious to see how the World Trade Center looks from the Brooklyn Bridge on the stream if you're casting it to a TV. I wonder if it gets a little bit pixelated just because the vantage point or the viewpoint is so wide. Ruby Falcone says it looks crisp and clear. Love that. I mean, in person it looks amazing. So here's one last view of the World Trade Centers right here. Hey, Emmanuel says, Tom, I'm always watching on the TV. Love that. Katie says exercise gives you more energy. You know, I think what it is too is we talk a lot on the stream, back and forth amongst each other. And I think when you have conversations with other people, time flies like crazy. It's almost like in a time warp, but I really don't know how to explain it. The moment I start the stream and then start talking to you guys, like time's up and it's already, like right now we've been streaming for about 1 hour and 30 minutes. I feel like I just turned on the camera. Hey, MK says your kinetic motion is charging you. Like iPhones would have by now if Jobs was still alive. You know, it's a good point. Hey, Herbert, this stream is so good, I feel like I'm there in person. Thank you so much, Herbert. for the $2 donation. You are very, very kind. Thank you so much. So fun fact here, everybody. I'm not too sure what the name of this building is called right here. But if anybody watches, well, let me not describe it like that. I'm going to give them more credit because they're an incredibly, incredibly talented musical group. So the Roots Group, if anybody is familiar with the Roots Group, one of the most talented musical acts of all time, in my opinion, the Roots. I believe their lead drummer, which is Questlove, lives in this building right here. And they are also the band of Jimmy Fallon, so Late Night with Jimmy Fallon, the Roots Group. So if anybody knows Questlove, I believe the drummer lives in that building, I think. And during the day, like that's why I said, if you come to New York and you want to walk across the Brooklyn Bridge, you got to do it in the same day. You got to do one walk across while it's light out, and then you also have to walk across in the nighttime because the view is different. I don't know how to explain it. When it's light out, you can see like the contours of the buildings and the contrast of the buildings. So let's just say the facade of that building looks extremely unique during the daytime. Hey, Dusty Cole is joining us. Good to see you. Says, I've been missing the stream. How is everybody? We're doing good. We're talking about the FOMC meeting concluding today, a 75 basis point rate hike. Yeah, Western Mass Dave says the Roots are awesome. Love the Roots. Victorious is the World Trade Center. Is so magnificent. Agreed. Hey, Tish TV says, Tom, my TV is 72 inches and it looks great in my living room. Love that. Estelle is here. Welcome, Estelle from Australia. Hey, Tom AK says, good to see you, Tom. I'm joining late. Tom, we're right on time. It's always a party when you join. So on the way back, everybody, let's take a walk through Chinatown. Hold on, let me adjust my brightness so we can make it all the way. All right, perfect. We're on 50% battery, so we're ready to rock and roll. So we're gonna head through Chinatown. I actually took a break after work. I walked all the way to Chinatown, in which case I ate at one of my favorite Chinese restaurants, which we'll walk past today. But since it's nighttime, Chinatown is gonna look so gorgeous because I don't really know how to explain it. I never remember what those lanterns are called. I know they have a specific name, or maybe they don't. But the lanterns are really, really gorgeous. It's a red light. Red light. The lanterns are very, very gorgeous over there in Chinatown. So we'll walk, we'll talk, and we will see it. Hey, Patricia Ivory is here. Good to see you, Patricia. Welcome, welcome. You know, I forget the name of the restaurant, but we will take a walk and we'll check it out. I'm horrible with names. I really should remember the name. Ah, they're paper lanterns. Got it. Jose says they're paper lanterns. Says it symbolizes good luck and good wishes. I'm all about that. Love that. So now we are going to pass the courthouses. So a little bit of a fun fact, I think I was exactly 17 and a half. I came down here in this building, and this is where you take the NYPD test. So anytime you want to apply for like a civil service job in New York, you have to take a test. And I believe you're eligible for the test once you turn 17 and a half. So I believe the NYPD test is right in this building still. And that is where I took it. I forget the address. It's like 2 something, but I took the NYPD test right there a long, long time ago, many moons ago. And it took almost 7 years for them to get back to me. I mean, that just gives you an idea of how long it takes if you want to apply for, one of these civil service jobs in New York. It could take many years. Sometimes it could take 10 years for you to get a call back. That is just how popular a lot of these jobs are. Also, I think sanitation, you have to take the test as well, I believe. It may be in the same building or it may not be. I'm actually not sure. Yeah, Nirvana Fan 500 says 7 years, yeah. And that's actually relatively short. Or was it 6 years? I think it's right, it's 6 years, because I got the call my senior year of college. So yes, 6 years actually. Apologize. Jetstar says the courthouse was a location for a TV show. So I think they shoot a lot of episodes of Law and Order here, don't they? And also, I think this is where Elon Musk had his court case. Wow, Dolly Girl Twins says my friends got in very quickly. Yeah, I think there's like tiers. So it depends on the amount of points you have. Like if your family is in the NYPD, you get more points and you get called faster, things like that. Or I forget how it works, but I remember it took like 6 years for me to get a call. And then once I got the call, I'm like, I don't want to do this anymore. Which is I was talking to an NYPD captain while I was interested in becoming an NYPD officer, and he told me like literally that exact thing. He's like, what'll probably happen is you'll take the test, 5 or 6 years will go by, and then you'll say, actually I don't want to do this. And then that's, when the numbers open up for everybody else. So the more people that get called and don't want to do it, the more spots are available for other people. And I think the NYPD has the highest drop rate. I think the lowest drop rate, surprisingly, is the sanitation department, which is another good civil service job to have in New York. So sanitation, they collect the garbage, obviously, but they also keep the roads clear and safe during major weather events like storms and hurricanes. Yeah, Western Mass Dave's like, that's some story. Hey, Florence Lugo says, yes, that's correct. At 2 Lafayette is the city jobs. I passed the sanitation exam, but they never called me. Wow. There was a lot of people before me, yeah. Yeah, it's so strange. And when I heard about that, to your point, I think the reason why it's very hard to get a call for sanitation is because every time somebody comes up and gets their number called, for whatever reason, I don't know, I really can't tell you, they never pass on it. These people really, that's the most desired, or one of the most, I shouldn't say the most, one of the most desired city jobs is sanitation, and I believe NYPD has the highest drop rate, which I dropped mine. But yeah, it was many moons ago. I remember taking it there. I think I almost got a perfect score on it too. Florence says they picked the highest scores first. Well, I think I almost got like a perfect score on mine, on my NYPD test. Maybe civil service is different, but.
Dolly Girl Twin says, Tom, yes, you're right. I have a couple friends in the sector and they won't leave. So we'll talk about that for a minute because I think it's important as well. It does relate to investments when we talk about pension funds. So one of the reasons, it wasn't like a huge reason as to why I didn't take the job or I dropped my number for the NYPD. But there's tiers. In New York City, they have a ladder system for the pension, so it's like a tiered. So a lot of the guys that you hear about, you know, they'll often post like a New York Post article freaking out, saying this sanitation worker has a $300,000 a year pension, and everybody gets all upset. They run one of those articles like once every 2 years, just to rile people up. But that's like a very, very small subsegment of people. I think now they're up to like a tier 7 or a tier 6. So the pensions are not as crazy as they were before. So that's another myth. Because you guys know me, I'm very analytical and I'm obsessed with finance. So as I was looking into the NYPD pension, I was like, wait, this isn't what they talk about in the New York Post at all. So it's not like what it used to be. So all of the new, really quick, we are now in Chinatown, so we're going to do a quick walkthrough. This is the corner of Mott Street, so we're going to walk down Mott Street this way. Hey, Elaine is here, says Deer Walks from Wall Street. Thank you very much for all your efforts until now and present and in the future. That we may enjoy a fantastic video to look forward. Truly, Ed, thank you so much. I appreciate it. And thank you for joining the chat tonight. But yeah, so there's tiered pensions now, and I think it's up to number 7. So it's not those crazy behemoth pensions that people used to get back in the day. It's actually not too good. But this is the Chinatown Arcade. So it's an actual functioning arcade. Very cool here. I think I've actually been in here a couple times, but I think this is one of the only standing arcades around. So very, very cool. Yeah, sunshine after rain's like, wow, it's a literal arcade. I've been in here a couple times. Here, I'll show you guys the, I think this guy is called Yoshi, Chinatown Fair Arcade. Hey, Lee is here. What's up, Lee? Lee knows all about the pension system. Says, yeah, New York pensions. Yeah, for sure. Yeah, Lee, I was just telling the story about how I was analyzing my pension. Well, I was never in the NYPD. I was going to go into it. And the pensions are not good now. I shouldn't say not good. That's going to cause too much controversy. But it's not like what it was before where, you know, 200 grand a year for the rest of your life. It's not like that anymore. Oh my God, look at these things. I think these are eels. Yikes. Those things look kind of cool. But everybody, we'll get back on track. I know we sort of deviated off path, but I think it's fun to do that sometimes. But for the people who were just joining, today was a big day on Wall Street. Very important to cover. The conclusion of the FOMC meeting happened today. Fed Chair Jerome Powell did make the decision to raise the Fed funds rate by 75 basis points. The futures market was pricing in about a 90% probability of that happening. Before the CPI number came out, we were actually highly anticipating a 50 basis point rate hike, but the CPI numbers came in a lot hotter than expected. But if you look at the core CPI, that actually moderated a little bit. Hey, what's up? Good to see you.
What up to the vlog?
Hey, good to see you.
What are we vlogging? Are we live? Where are we live at?
So you could follow Walks Wall Street.
Yeah.
We do like a financial show. We walk around the city between New York City and Miami.
Were you on Twitch?
Oh no, it's YouTube. It's yeah, on YouTube.
What
Yeah.
up, YouTube?
Yeah, good to see you.
What up, YouTube?
Good to see
out
you.
here in New York City.
Awesome.
Follow my man right now. Follow him. Give him a like.
All right, appreciate
Smash
it.
that like button.
Be safe, guys.
Yeah, take care, man.
See you, man. See ya. So what I was saying is, if you look at the core CPI, which excludes volatile food and energy, that actually moderated a little bit, which sort of coincides with our thesis on the stream all along. But here's the concerning factor. Even though we have a 75 basis point rate hike that brings the Fed funds rate to about 1.5% to 1.75%. If we fast forward to the end of the year, it's projected that the Fed funds rate will be at 3.4%, which is still actually historically low. And using Fed Chair Jerome Powell's words, may not be enough to kill off inflation. So there's a big possibility that we could be doing what's called tightening into a recession. And this is almost uncharted waters, because before, when we had inflationary pressures and the stock market lower, the Federal Reserve had more tools to work with, and the Fed funds rate was a lot higher at the time. So a lot of people are calling for a Volcker style Paul Volcker style system, where they bring rates all the way up to 20% at that one time. But I think that would cause an absolute cataclysmic shock to the market. I just want to make sure nobody's... Hey, Victoria, thank you so much for joining tonight. I appreciate it. Unlimited stimulus is, do we get 3% rate this year by Powell? By the end of the year, it's projected the Fed funds rate will be about right around there. But this is what I was talking about, guys. The lanterns are extremely beautiful. I wish I could stream earlier in the day just to show you guys, because Chinatown looks a lot different during the day. A lot more people around. Obviously, the shops are open. Laura E says they are tearing the Band-Aid off slowly, but I don't think it matters, says Laura E. Yeah, so Bill Ackman came out with a tweet saying something similar. Explorations is 3.4%, you're right. Bill Ackman was saying something similar. He was actually calling for 100 basis points. He's like, if the Fed could do 100, that would be better. And then to do an additional 100 next FOMC meeting. But the real essential topic for tonight's stream is, you guys know me, we've always talked about the monetary side of the house. We always said, oh, the Federal Reserve is the number one cause for inflation. So on tonight's stream, for about the first hour, maybe hour and a half of the stream, this is where I ate, by the way, hour and a half of the stream, we were talking about the potential for fiscal policy to impact inflation just as much, if not maybe even a little bit more, than monetary policy. So I think that Federal Reserve Chairman Jerome Powell can take a lot of heat, and I think rightfully so, but I do think our politicians and our governments share in the blame of inflationary pressures as well. So we were talking about the difference between fiscal and monetary policy, and also supply chain. If you listen to the Fed chair's speech today, he did say that, especially due to the zero COVID policy in China, that is putting additional pressure on supply chains, thus causing inflation. And I'm also seeing that in my everyday work life as well, in enterprise tech sales, especially as I have to go around to different OEMs to manufacture custom equipment, whether that be for an SD-WAN deployment, different routers, things like that, medical devices, medical equipment. A lot of this stuff has like a 7-month lead time. So definitely causing extreme inflationary pressures. 456 Shanghai restaurant. It's somewhat good. I ate there once. You know, there is also another restaurant that everybody loves. I think it's called Joe Shanghai. I think it's a little bit overrated. There's a lot better restaurants on this street. Some of the smaller shops and less known. But we're crossing Canal Street, so this is the main street that runs east to west. But we are about to head towards Little Italy. Natalie says your voice sounds different tonight. It does because we have the microphone, and my microphone is almost like falling off, so we may sound a little bit more muffled tonight. So every time we have the mic, it does change the tonality of the voice, I think. Photos around New York's like Joe Shanghai has a good review on Yelp. That's why a lot of tourists go there. I went there a couple times. It's all right. Bagels and Walks. That's a good place too. Hey, Melee is here. Good to see you. Welcome. Tony Logus says, hey, my friend, how are you, mate? Enjoying this beautiful evening walk and have a coffee from Australia. Thank you so much. Appreciate it. Here's another dim sum place. I don't think I've ever eaten here, but apparently they're featured in the New York Times. I mean, there's so many good places down here. It's like insane. I actually think my friend may have lived in this apartment building, but it unfortunately had a fire. I think this was almost 2 years ago now. But we are going to make a left because I want to walk through Little Italy. I want to show you guys Little Italy. We might as well do the whole loop as we head uptown. This is Vincent's on the left-hand side. Hey, JC's, this is creepy to walk around the city at night. So welcome to Little Italy, here we are. Yeah, so Nicholas, you're right. I think there's a very big Little Italy in the Bronx, which I've only been to a couple times actually. But there's a very big one in the Bronx. Andy S is like Tom knows karate. All right, Mulberry Street. And it just looks like everything is just closing up now. That probably means it's right at maybe 11:15, almost 11:30 at night. Is that right, everybody in the chat? If we do a quick time check, it looks like all the patrons are just finishing up their dinner. Beautiful outdoor dining setup here. Yeah, Photos Around New York says the Little Italy in the Bronx is on Arthur Avenue. You're right. Ferrara Bakery is closed? Let's check it out. I think you're right. Man, So the Empire State Building's lit up in entirely green tonight. I wonder why. Hey, Sunshine New York City says I get the notification at 11:23. Sunshine NYC, always a pleasure. Good to see you. Hopefully you're having a good middle of the week. This week is flying by the way. So this is my favorite building in Little Italy because you see, if you look at the screen, if you look at your screen on the right side, you see the Empire State Building. You see the outdoor dining setups. You see the white fire escapes and the restaurant sign. Very classic shot in New York right here. Frankie and Johnny's in the Bronx is a great Italian restaurant. Let me take a screenshot of that. I've never heard of that place. I may have to check that out. This place is all year round Christmas shop, Christmas in New York. Yeah, Ryan Royals like it looks like a movie set. You should see it during the day. I walked through here during the day. There was so many people out for a Wednesday. It was beautiful here. So if you saw the guy on the left, that was the guy, I forget his name, I think his name is Tommy, but his nephew is on America's Got Talent. An amazing talent, his nephew. I think he's around my age, and he sings all the classic Italian songs. And we just passed him, he was right there. I always see him eating outside of that restaurant. But this is Ferrara Bakery right here. One of my favorite places to get pastries. Yeah, does anybody know what I'm talking about? So there was a guy on America's Got Talent. I think this was about 5 years ago now. And, hold on, let me cross the street. And there's this young kid, I forget his name, but I believe he was from Staten Island, and he would do all of the old Frank Sinatra, Dean Martin songs, and he was an amazing talent. And his uncle had a big personality, and they always put him on America's Got Talent. He was always on the sidelines watching his nephew. And we just passed him. Christian says, remember you said you were half Italiano? Yeah. So I'm half and half Irish and Italian. You are right. So I halfway fit right in. Yeah, so that's who it is. It's Sal Valentinetti. That is the act. So if you guys want to look it up on YouTube, Sal Valentinetti, really good talent. You know, a lot of my friends watch this show, The Sopranos. I've actually never seen it. I've only seen clips of it on YouTube. I may have to watch it. It says if one family doesn't kill him, the other one will. All right, so now we are exiting Little Italy. I just want to make sure we are focused here. We're walking up Mulberry Street. Ooh, that was a massive rat. That rat almost jumped right on me. Somebody says, any rude New Yorkers harassing you yet? I am the rude New Yorker, so I tend to harass myself. Durman says, what's up, Tom? Why are you streaming so late? So I usually work during the day, so I really don't have time to stream during the day. So if I'm working like 8 to 12 hours a day, it's very hard for me to stream at any other time, but usually around 8:30 or 9. Oh, there's a good place over here called Zuba, which is a very good Egyptian restaurant. I think I've talked to you guys about before. Wesley West. Yeah, the rats are everywhere. So we'll see how the market reacts. You know, a lot of people were calling for a big bounce today. So even though the markets were up, it was rather light volume. So there's really not a bid in this market. So I really wouldn't try to be bottom fishing here. And the number one thing that was a little bit weird for me today is the VIX actually collapsed, in a really, really big way. And that's actually not sort of what we want to see. What I would rather see is a lot of volume come out on the downside of this market and have the VIX blow up and go to Mars. So that sort of signals complacency to me in this market. Also, the put to call ratio. If we put it into perspective, the last time we had a major market sell-off, we talk about the last two major markets sell-offs. Number one was in 2018, in which case the market actually bottomed on Christmas Eve. And the put to call ratio, I think, got up around 3. And the VIX, I believe, was in the low 60s. Right now, the VIX is right around, I think, 30, 33, 34. After that, in 2020, obviously we had the COVID sell-off. The put to call ratio went to 3. The VIX almost went to 80. I think the VIX may have went higher than it did during the 07-08 financial crisis. But now, even though we're starting to make that third leg down in the market, those two necessary indicators that really signal a market bottom, they're really not flashing. So that could mean we could have a lot lower to go in this market. Doesn't mean we can't bounce, but usually what happens during bear markets is we'll have these crazy neck snapper rallies, in which case the market will rally back up to the 50-day moving average or the 200-day moving average and then be turned away by the moving average, and the market will start to roll back over. Another thing I wanted to touch on, and we sort of touched on this last night, but I was seeing this a lot on Twitter today, and it's very interesting because we were talking about it last night. But if you want to follow us on Twitter, you can follow @WalksWallStreet. I post a lot of my financial analysis on there as well. But a lot of people, a lot of analysts on the street, and a lot of very notable PMs, we're talking about how the forward PE on the S&P is roughly around 17 now. And historically, if you buy the S&P at like a 16 forward PE or a 17 forward PE, it's actually relatively cheap and it tends to be a good buy. But here's the other side of that argument. The other side of that argument could be, well, as we go into a recession, which we could already be in a recession, we just don't have the confirmation of that yet because we don't have the numbers out, companies may start to revise their earnings lower. And if they revise their earnings lower, well, that's going to adjust the forward PE multiple. So the E in the PE could change. And I have a feeling that may happen. It's possible because out of all the earnings reports we've been seeing roll around, the vast majority of companies may either meet or exceed their EPS. But the concerning thing to me is that they tend to be guiding lower, or they tend to be revising their forward guidance for either the full fiscal year or the coming up quarters. So I think if you have a basic retirement account or an IRA, something like that, and you're young, I think if you deploy a little bit of capital for the long term, I mean, in your retirement account, you're probably not going to touch it until you're 70. You know, that's 50 years. If you're 20 years old, you deploy some capital now, probably a pretty good buy. Probably corporate profits are going to be way up 50 years from now than they are today. But if you're sort of trying to manage risk, or you're running money for other people, or you're a manager right now, I think you got to be a little bit more careful and wait for a follow-through day. Hey, Steph writes, as I'm heading out myself now, enjoyed the stream, and thank you for the walk. Steph, thank you for being here. We appreciate it very much. We will see you tomorrow. Tomorrow we may be on the Upper West Side. We may be streaming from the Upper West Side. This is one of my favorite coffee shops in the city. It's called Gasoline Alley Coffee right here. But if you guys are enjoying the stream so far tonight, feel free to hit the like button and subscribe if you are new. Western Mass Dave says, yes, start young and think big. Flat Smacks says, in 50 years might be good. I think you're right. You know, I was posting on Twitter, this is almost like 6 months ago now. Maybe not as far back as 6 months ago, maybe 3 months ago. Usually, generational buying opportunities for Bitcoin present themselves right around the 200-week moving average. So if you want to keep your cost basis relatively low, you should be looking to buy right around the 200-week moving average, historically. So I actually, in full disclosure, and when I say this, this is not a recommendation to do anything, we're just talking randomly on the internet. I did buy some more Bitcoin at the 200-week moving average, which we hit yesterday. Now, my strategy, and I've told you guys my value proposition that I see with Bitcoin, I take all of my Bitcoin off the exchange and store it in cold storage, which is totally offline. But really the only times I'll add to my Bitcoin positions are at that 200-week moving average. But here's the thing. This sort of reminds me of a quote by Bernard Baruch. And Bernard Baruch is a very, very famous financier, or was. There's actually a college, a beautiful Tesla right here. There's actually a college in New York City named after him. And he'll say, if you show me the charts, I'll tell you the news. If you show me the charts, I will tell you the news. And right now, if you look at a chart of Bitcoin, we are about probably, 70% off of the all-time highs of about 70,000. I think, hold on here. Let's just move out of this crowd for a minute. So I don't trade Bitcoin like I trade equities. I tend to think of Bitcoin more as a digital store of value, like you would hold gold or something like that. Oh, thanks, man. So for me, I want to try to accumulate Bitcoin at a lowest cost basis ever. It's not sort of the thesis that I have on equities, where I want to look for companies that are producing an enormous amount of free cash, compounding out their annualized growth rates at 25% or higher, compounding out their annualized revenue growth at 25% or higher, 25% return on equity. That is sort of my criteria for equities. But if you are sort of, let's say if you're a silver stacker or a gold stacker, your proposition or your value prop for gold or silver would be, I'm not trying to trade these things, because with a stock, a company can change, valuation metrics can change, companies can go out of business. With gold, it has historically been a way to preserve your wealth. That is sort of my thought process on Bitcoin. Could be wrong. I know there's a lot of debate. I know there's a lot of controversy. But for me, I try to get a lowest cost basis on that as possible, because I believe that once the SEC comes out, Gary Gensler and his friends, with extreme regulatory clarity in relation to Bitcoin, you're going to start to see institutions get in here. And I'm not talking about hedge funds. I'm talking about like the actual large sovereign wealth. And that, I think, will be a good diversification segment for those entities like the sovereign wealth funds. And once we have regulatory clarity, you'll see a lot of all of this scam nonsense go away, like the altcoins, like the Terra Luna Ponzi schemes, like the Celsius Ponzi schemes. All that stuff is going to go away once the SEC really gets a regulatory crackdown on this environment. So, long story short, if you look at on-chain metrics as well, big whales who have held Bitcoin for 7 to 10 years are actually not selling. They're actually buying more. Much of the selling pressure has been in accordance to forced liquidations and speculators. And that's another reason why I think we need more regulatory clarity in the cryptocurrency environment, because you have some of these unregulated exchanges that are offering 20 to 1 leverage, sometimes 100 to 1 leverage, which is insanity. So essentially you can get blown out of your positions. So the people that are ponying up here, leveraging out, they're all going bankrupt. And what we see if we look at on-chain metrics is the smart money is buying all their liquidations at low prices. But all the people who use extreme amounts of leverage, those are the people that are buying Bitcoin at 70 grand. The smart money, we're stacking at 20 grand, and we'll sell it back to you at 100 in a couple of years. Yeah, Matthew says margin calls, you're right. Hey, Nicole's here. What's up, Nicole? Good to see you. Hope you're well, Nicole. So we're walking past the Cube. Oh, look at these guys. So you know it's summer in New York City when you see these guys. Roy S. says, I'm a bit concerned about the Bitcoin situation in El Salvador. I'm actually a little bit concerned too, to be honest. And these guys get flying. These guys can go like 30 miles an hour on these things. So this is Astor Place, and everybody, Wegmans is coming. Big food supermarket Wegmans is going to be in here, I think by the end of next year, which is very exciting. Hey, Nicole says, can't wait to be in New York City next month. Awesome. July is definitely one of the better months to be in New York, for sure. Very, very fun time to be in New York. XXX is, what is the big black cube? This is a very famous cube right here. Right on the corner of Lafayette Street. Twitch ASMR says Bitcoin currently consumes an estimated 150 terawatt hours of electricity, more than the entire country of Argentina, population of 45 million. How could this be sustainable? Twitch ASMR, I think that's a very good point. But I did address that. I'm not sure if you are signed up for the Behind the Street newsletter. So we actually talked about that a little bit and how that is a little bit of a misconception. But if you want to read the piece that I wrote about that, if you type !news, this is the IBM Watson building, by the way. I was actually going to work here as an enterprise account executive on their Watson healthcare team. That never materialized. But if you type !news, NEWS, in the chat, feel free to sign up for the Behind the Street newsletter, where I did sort of outline that concern. But also, I think that Bitcoin can solve this climate crisis, because I think right now, so if you scan the QR code, I think that's an easier way to do it. So every other Tuesday, we send out a free financial newsletter where we talk about the US equity markets, emerging markets, fixed income, cryptocurrencies, and the housing market. We take like a top-down, bottom-up macro approach and then whittle down from there. But here's where I agree with you, Twitch TV. I agree with you 1,000%, because at the end of the day, here's a big problem. And it's not only in relation to Bitcoin, it's in relation to major companies as well. So the SEC knows that all of these carbon offsets are BS. So essentially, whenever you see or hear on the news about these companies placating and trying to virtue signal to you about how they're 100% green and we're 100% carbon neutral, it's all nonsense if you actually understand finance. And I'll sort of explain that a little bit. So in order to meet ESG requirements, what big corporations will do, and especially Bitcoin miners, to your point, it takes up so much energy. What they'll do is they'll buy carbon offsets. So that means maybe they'll build like a mangrove somewhere. And they'll say, see, we bought all of these, we invested all this money and bought these carbon credits and carbon offsets, so we're 100% green. That's not going to fly. At least I don't think it is anymore. I think the SEC is going to come out with rules to say no more of this stuff. No more just, if you have the capital and you have the cash flow, just to buy a bunch of carbon offsets and say you're green, you're ESG. It's not going to happen. And I don't want to get into the conversation of if we think ESG is nonsense or not. I think the vast majority of it is, but that's not the point. But here's where I think Bitcoin mining specifically could solve a really, really big problem, especially in upstate New York. If we talk about hydropower or unutilized or uncaptured hydropower in the United States, the vast majority of that is wasted is in upstate New York, where the economy is extremely, extremely depressed. A lot of these Bitcoin mining companies are extremely well capitalized. You can probably raise money through VC or whatever to say, hey, we'll build the turbines, we'll set up a Bitcoin mining operation, we'll build the infrastructure near a major water source to generate energy and generate power via 100% green hydropower, use that power to mine Bitcoin, and use the excess power to sell back to the grid to distribute to everybody else. But right now, traditional energy companies, the incentivization is not there for them to do that. But if you could churn a profit mining Bitcoin, you know, these Bitcoin mining companies will build the green energy infrastructure. They'll build the turbines to utilize that hydropower. So that's just one of the value propositions that I was thinking about. There's also other companies and other VCs that are thinking about doing things like that as well to sort of stay in compliance. Because to your point, if the SEC moves forward with their policy changes to make sure that, or to put a stop to all of this carbon offset business, that's not going to bode well for the Bitcoin miners at all. FredEx. Hey, Golf Endeavor is in the stream. What's up? Golf Endeavor, it's good to see you, man. Yeah, so usually you don't get to catch the streams live based on where you are in your neck of the woods, so it's good to see you. Yeah, we're streaming late tonight because we're coming up against the end of the stream here. But we walked all the way from the Brooklyn Bridge and we're headed back to Penn Station where we will conclude the stream, but I thought I might as well take you guys with me. But it's good to see you. It was Fed Day today. Hey, British Gray is here and Andy is here. Andy's joining us from Korea. Good to see you, Andy. So Andy, thank you for the clarification on the Jeju Island in Korea. You know, I was watching a news clip about Jeju Island, and supposedly the vast majority of their economic output comes from tourism, and they've been really affected, obviously, due to the COVID-19 pandemic. But now that things are opening back up, there's actually a lot of tourism coming back, which is a good thing. So now we are at East 14th Street. We should probably be back at Penn Station in, I don't know, I'd say 15 minutes. Wow, Golf Endeavor says, hey Tom, it's 6 a.m. here. Wow. Yeah, normally just starting to catch the replay. Good to see you, Golf Endeavor. You know, if you ever come back to New York or Miami, you know, we should play at the Normandy Isles or Normandy Shores Golf Club in Miami. Beautiful golf club. Also, one of the greatest courses in New York is out on Long Island. Drawing a blank on the name. But check out that Empire State Building here. Bethpage. So you could play the Bethpage Black course, which I believe is one of the most challenging courses. But that's actually not too far away from where I live, so. I wonder if they're putting in fiber here. Andy says, always good to see you, Tom, and your pronouncing is very good, yeah. Oh, we will, thanks. Sunshine, New York City says it must reek of weed. You know, honestly, tonight it doesn't. It really doesn't, to be honest. It usually reeks of weed in Washington Square Park. But here, surprisingly, no. Or maybe it's just that I'm so immune to it. Andy S.'s Miami is all about the shrubbery. Yeah, this is Union Square Park. Yeah, sunshine after rain is like probably immune. So here's a crazy story. Well, not really crazy. So ever since I moved or bought a place in Miami, Florida, every time I would have somebody visit me in New York, they would say, oh my gosh, New York City smells so bad. It smells like garbage everywhere. And I'm like, what are you talking about? I'm like, it doesn't smell at all. And they're like, dude, that's probably because you're used to it. And I'm like, no, that's fake news. I'm like, that's probably total fake news. So ever since I've started, spending 2-3 weeks a month in Miami, I've started to notice the garbage smell here. It's like the weirdest thing. And that's not a knock against New York City, by the way. I love New York City. It's the greatest city on earth. But I'm actually starting to notice it. Like, I notice the garbage smell. It smells horrible. Yeah, Nicole's like, I never thought I smelled it either. Like, maybe it's just because I've been here forever, but when I've,
7 p.m.
but then again, I do live in the suburbs in Miami where it's not like a city. Bot says, how much does it cost to own a 1-bedroom apartment? To own a 1-bedroom? Probably $1 million, maybe more, depending on where it is. I think you could probably get a studio for like $600,000. But I think once you get to the 1-bedrooms, if you want to live in Manhattan. So when you say New York City, I think about the city, which is Manhattan. But maybe if you venture out to the Bronx, which is technically New York City, you could probably get it, for well under $1 million. But if you want to talk about Manhattan, if you want to live in the city, I would probably say right around there. But a studio you could probably get for like $500, $600. Tabar says, I grew up with that smell in New York City back in the 70s where the garbage men went on strike. Oh my God. Yeah, I don't know if it's that bad. It's not like terrible, but when you pass something like this, you'll maybe smell it for a couple blocks and then it'll go away. But yeah, probably not like back in the 70s when they went on strike. Yeah, so, okay, Photos from Around New York makes a very good point too. He says, don't forget about the property taxes and the maintenance. So a lot of times like the maintenance or the HOA fees could be a couple $100 a month. Or if you get into like a really nice building, it could be like $1,000 bucks. Guzman says, good to see you, Tom. All good. What's up, Guzman? What's up? Donovan says, the smell used to be 42nd Street before Disney. Before Disney. Where I notice the smell the worst is usually 34th Street near Penn Station. But to be fair, they are doing a crazy amount of renovation all around 34th Street, the new Penn Station project. Yeah, Golf Endeavor says house prices are exploding. So Golf Endeavor, we were talking about that as well because there was something very telling that Fed Chair Jerome Powell said during the meeting. And he said something really interesting that was thought-provoking. He was asked the question, I believe, by like a New York Times reporter. He said, what do you think about the future of the housing market in accordance to your interest rate policies? Obviously, we got a 75 basis point rate hike. So he said, if you were a young person in America and you're looking to buy a house, you want a reset. Now, I don't want to put words in the guy's mouth, but the way I took that is he said, look, as we raise rates, it's probably going to crash the housing market. That's not what I'm saying. That's how I interpreted what Fed Chair Jerome Powell said. He's like, if you're a young person in America looking to buy your first house, you're going to want a reset, which means prices to come down, a whole new cycle all over again. The first hour of the stream, we talked about my opinion on that. I don't think we're going to get a full-on housing crash. I think we'll get a correction, but I don't think the wave of defaults will be so big, just like it was in 2008, when people were very unqualified. The underwriting policies weren't as good. I think we'll probably see some defaults, some houses come back on the market. A lot of people who are speculating in single family, who are either trying to flip houses or something like that, a lot of those will go back to the banks. But I don't think we'll see a full-on crash because inventories are still relatively low. I do think we'll see a little bit of a correction, but I don't think it'll be as bad as 08. But that's just my opinion, could be wrong. But everybody, check this out. Such a unique color, by the way. Such a unique color here at the Empire State Building. It looks absolutely beautiful. Golf Endeavor says, yeah, Tom, they are also talking of a possible housing crash here in Europe. Well, I think there's a very popular metric. House to income, I forget the exact name of it, but it's the worst in places like Australia and Japan. I think it's, in terms of your income to house price ratio, I forget the exact name. We're going on 3 hours. I'm getting a little brain fog here. But it's actually not that bad in the United States. Hey, Snarky Traveler is here. It says, hey Tom, catching up on today's stream. Real estate agent here in Toronto. We're not seeing prices going down, rather selling closer to asking. Last year I had $1 million condo sell $500K over ask. Oh my God. Yeah, so Snarky Traveler, that's really good insight there. So Snarky Traveler is a real estate agent in Toronto. So Canada, I'd say, I mean, if you think the pricing or the housing market is crazy here, go to a place like Toronto or Montreal, Canada. I think it's probably right about 2 times worse in terms of your income ratio to the prices of homes. But that's crazy, $500K over ask. You know, one of my theses, I'll sum it up really quick, because I sort of laid out the worst, what I think would be technically the worst case scenario for the market. I won't really do the elongated version. If you want to see that, you could rewind the stream to the part when we were on the Brooklyn Bridge. But I think the worst case scenario for the middle class would be if housing prices only went down 10%, and here's why. If housing prices only went down 10%, while the Federal Reserve continues to raise interest rates, that means a 30-year fixed rate mortgage will probably go to 10%. If your $500,000 house only went down 10%, that means that home is still about 50% less affordable than it was when rates were still at 3%. So that means the only people who could really afford to buy are institutions that are well capitalized, that'll come into the market and buy the house with all cash at a 10% discount, in which case, as we move into the 4th year of the Biden presidency, by that time the Federal Reserve should be able to get inflation under control, in which they could potentially start quantitative easing and even lowering interest rates and then causing asset prices to go back up. But again, that is speculation, but I think if the market only corrects 10% while rates, a 30-year fixed rate mortgage right now is about 6 and change. If it goes to 10 or even 12 and housing prices only come down like 10%, it's going to still be more, it's going to be more expensive to own a home in terms of the monthly mortgage payment. So I think that's worst case scenario. It's a little bit weird. You would think, hey, house prices are coming down 10%, but if you can't afford to pay all cash, you know, you're gonna have to pay for that money one way or another, and the money is gonna cost you 10%. Hey, Anthony says, I heard in Chinese and Canadian are buying up homes. Yeah, so a lot of foreign buyers you're talking about, yeah. So there is reason for that. I think a lot of wealth is trying to escape China, so a lot of the ways that they can export money out of China is to buy real estate in the United States and other parts of the world. But everybody, I am on 10% battery, so I gotta wrap it up. But it was a fun stream, I enjoyed it. Thank you everybody for joining me on our walk over the Brooklyn Bridge. We covered a lot, we shared a lot of good ideas. We will be back live tomorrow, 8:30 Eastern Standard Time. That I could promise you, that is a guarantee. So join us tomorrow night, 8:30 Eastern Standard Time. We will be live from the Upper West Side of Manhattan. We haven't been to the Upper West Side in a long time, so we'll be able to see the Museum of Natural History. Maybe we'll go through Washington Square Park. We'll see a couple raccoons coming out of the garbage cans. It'll be a good time. So everybody, please leave a like on this video if you enjoyed today's stream. Subscribe if you are new. And lastly, if you have not yet signed up for the Behind the Street newsletter, please do so. If you type !news in the chat, NEWS, you'll be able to click the link and sign up, or you could scan the QR code and sign up. And to the Mighty Bull, have a good night wherever you are, because there's always a bull market somewhere. You just need to know where to look. So FredEx, Otto, Bob, Fascinating, everybody. We'll see you tomorrow, 8:30 Eastern Standard Time. We'll see you in the next one.